During a market correction, look for stocks that have strong closing ranges, even while they're declining. When you're first starting out, you don't just want to take a sheet of patterns and memorize and just look for that. You want to understand why the trend is changing. You shouldn't have a moving average on your chart just so you have 5 moving averages on the chart. That's just noise at that point. Make sure it has a purpose.
The existing slope of multiple moving averages being flat will tell you that it's now time to make a decision on whatever the primary trend was, if that's going to continue, or that primary trend is going to switch to the opposite of what, could be a downtrend.
One bar can represent a year, it can represent a day, a week, a month. It doesn't really matter. All it's taking into account is it's visualizing the movement of price action over that period. Now we're going to touch on building a trading foundation when it comes to reading price and volume action. Now, this may seem basic to some of you, but it's really important that we all start from the same foundation and kind of wipe the slate clean so then we can build off of that, right? I promise we're going to get into the complexities and nuances and all of that, but this foundation, it gets you 90% of the way there, honestly. Like we just said, keep it simple, price, volume, action. All right, let's see. So here we go. I said we're going to keep it simple. This is as simple as you can get, right? But you got to learn addition and multiplication before you learn calculus or differential equations and partial differential equations, whatever Rye you did for electrical engineering. I don't know what you did over there, but yeah. So this is the most basic aspect, right? What is a price bar? Over here on the left, we've got an open, high, low, close bar. This is the open. This is the close. Here's the high for the day. Here is the low of the day. Some people probably prefer candlesticks. It represents the exact same information. But in the chat, just to start some drama, let me know if you're team OHLC bars or team candlesticks. I'd be interested. So let's see. We'll see in the chat here. Candlesticks, OHLC. I'm team bar myself. Rye is team candlesticks. So we've got the two parties represented here.
I switch back and forth. But
yeah.
For me, like as you go with more experience, you can switch back and forth. It doesn't really matter.
Yeah, I learned first on bars, so I think that's pretty much why I like that first. But basically, one bar can represent a year, it can represent a day, a week, a month, 65-minute period, 63-minute period, 20 seconds. It doesn't really matter. All it's taking into account is it's visualizing the movement of price action over that period, and how these 4 data points are organized, the high, the low, the open, the close, how they're organized gives you insight into the supply and demand characteristics going on behind the scenes during that candle, whether buying pressure was stronger, selling pressure was stronger. All of that is shown in the candles, and we'll talk through exactly how to interpret that. All right, and here's what I was just saying. So this is a way to visualize a bar if you kind of need. I like analogies, as you might have noticed. So this bar here, if you flip it on its side, so you turn it 90 degrees where the low is over to the left, the high is over to the right, basically the buying pressure is trying to pull it to the right, pulling this close, the current price, up towards the high, while the selling pressure is trying to pull things over to the left towards the low. And whichever is stronger is going to dominate that candle, and it will show up in where the close is relative to the high and low. If the buyers are stronger, we're going to be closing right near the high. If the sellers are stronger, we're going to close it near the low. And maybe, it changes within the candle. Maybe initially the buyers were super strong. It opens here. We push all the way here, but then the sellers really step on the gas and it closes the bar all the way down here. That's, again, information about what's going on behind the scenes. And it could be the opposite. Maybe we open up here, sellers, selling pressure overwhelmed everything. We push all the way down the low, but then buyers really took hold and we close all the way near the top. That's what a lot of people call a hammer candle, right? And these names, that we give candlestick patterns, they're not really important. What's important is kind of the psychology behind the bar and interpreting that. And that's kind of what I just went through. And a really easy way to interpret it is just visualize selling pressure as try to pull stuff down to the low, and buying pressure pulling it up to the high. And that gives you kind of a clear analogy of what's going on behind the scenes. And A really handy way to make a data point out of this that you can screen by, and we've got this in DeepView as we'll go through in just a second, is the closing range. And basically what it is, you don't even have to worry about formulas if you're not math inclined. Just think about from the high to the low, where is the close within that range? The closing range is going to be closer to 100%, and you have to multiply this by 100, by the way. The closing range is going to be closer to 100% the higher we are, or the closer we are to the high of the bar. Thanks, Rye. Glad it's 11. But on the flip side, if the close is right near the lows, this ratio is going to be close to 0%. So, if this is the line in the sand, in this game of tug of war, the buying pressure is stronger if we're above 50% of the bar. The selling pressure is stronger if we're below 50% on the bar. So hopefully that makes sense. And I think this is a really powerful concept. And in DeepView, we have it both on a daily and weekly basis right there for you as a data column. You can put in your data panel, all of that. And
Monthly
we've got monthly as well. And we've got a visualization of the bar right there. And I'll actually show that, right now. So over here on the left-hand side, we've got the DCR, the daily closing range. This is IoT. It had a daily closing range of 96% because on this day, we're closing almost right near the highs. If this moved up and then fell back down and closed right here, it would be about a 30% closing range, right? Because we're at about 30% of this range. The weekly closing range, maybe this wasn't the best example because the weekly closing range is also very close to the high of the week because that range takes into account the high and low of that entire week, and we're also closing right near the high. But hopefully that makes sense, and let me know in the chat if you want me to explain that more. But this visualization in DeepView where we create the bar for you, where it's a full candlestick pretty much. If the daily closing range is 100% or close to it, you'll see it. If it's very low, you'll see the low closing range as well. That's super handy because you don't even need to look at the chart almost. You can get a sense of what the stock is doing just with this visualization, the price percent change and the volume as well, which is another piece of the puzzle. All right. So weekly closing range during corrections. This is something that I picked up from Mike Webster. He did a webinar, I think it was with the Arusha and maybe Joe Fahmy a while ago. But something that he picked up from William O'Neill is during a market correction, look for stocks that have strong closing ranges, even while they're declining. So this is during the 2020 correction. You can see each of these bars represents 1 week's worth of price action. And you can see that 3 out of these 4 down weeks close basically high up in the range. They're closing far off the lows. This one, it is kind of neutral. But the 1, 2, 3, these 3 bars, look at them. They're basically forming crosses here. They're closing pretty close to highs, even though the market is declining 30% in the most rapid, correction of I think it was ever, maybe outside the crashes. But this stock was fighting against that. It was being accumulated, pushed up by institutions. And after, the market pressure lifted, we had a beautiful trend. I think this went on and doubled. And there's so many examples from this time of stocks that were fighting the trend, good closing ranges, even when the market was going down rapidly. And you can also see this in the relative strength line. You can see, this trend is increasing even as the stock is declining. And these pink circles here identify when the relative strength is making a new high. And you can see it's happening before price. Price does not make a new high until way over here. But you had many early signals of strength by looking at the relative strength line. It's increasing over this period. It makes a new high on this bar well before we actually break out of the base. So that's another thing that you should be on the lookout for. And we'll probably dive deeper into the relative strength line later on in a future webinar. But what's important is to look at the weekly closing range during a correction. So next up, identifying trends. Again, we're keeping this simple, but I promise we're going to build off this. Very simply, what you can do is add a moving average to the chart. And we get asked so many times, what's the perfect moving average? What time period should I use? It doesn't really matter. It should fit your kind of time frame. If you're an intermediate term trader, maybe the 50-day is good for you, 200-day is good for you. If you're more of a faster swing trader, maybe the 5-day simple moving average is good for you. The 10-day simple, the 21 EMA, align them with your time frames, and they should have a purpose, right? They should either help you identify the trend, or you should have rules dependent on them, right? You shouldn't have a moving average on your chart just so you have 5 moving averages on the chart. That's just noise at that point. Make sure it has a purpose. Here we're on a weekly chart of, again, NVIDIA. This time we're looking at the 2022 correction as well as the uptrend that resulted from it. We've got a 10-week moving average in red here. Also, when it comes to choosing moving averages, a lot of people focus on certain ones, which makes them a level of interest, to quote Brian Shannon. So it's often good, the 10-week is a known spot of institutional support, 50 days the same, 200 days the same. So use your discretion, find what works for you, and also look at what the stock itself respects in the past. But getting back to this, just looking at the trend of the moving average and price action relative to that, you can identify and sidestep a lot of the major corrections. Here we're above a rising moving average. That's good. Here we're below declining moving average. We pop up a little bit, but we get back down below declining moving average. This is the definition of a downtrend. We're trending below a moving average, the average price over a period. And that doesn't change until pretty much here, where consistently we're above a rising moving average, and now it's held that for many months in a row now. So just adding 1 or 2, keep it simple again, moving averages can really help you define that trend. And we're always looking for uptrends above a rising moving average, and that can last, that trend above the moving average can last a lot longer than you think. But also on the flip side, trend below a declining moving average, that can also last a lot longer than you think. And then one more way to define a trend is just looking at relative peaks and relative lows, and looking at what the trend is here. Here we're in an uptrend, we're making higher highs. Then we make a lower high. It's an intermediate, it's still a higher low here, but then we make a lower low. We make another lower high. We make another lower low, lower high, lower high, lower low. So if we're making lower highs and lower lows, that's another way to define a downtrend. And then at this point, we make a higher low compared to this low. We make a higher high compared to this high, and the trend changes, and off we go to the races. So for downtrends, lower highs and lower lows. For uptrends, higher highs and higher lows. And that's kind of the definition, another way to define a change in trend. And Ryan, jump in if you want to add anything to what I'm saying here.
Yeah, no, I think you discussed, the slope of the moving average kind of tells you all you really need to know, right? For a trend to confirm, a very simple way of looking at it is the slope of, let's say, the 10-week line, what that means. So if the slope is down, it means that the stock on a 10-week closing basis has trended lower. If the slope of the 10-week line is up, it means that over the last 10 weeks, the average weekly closes are now trending higher, right? So as that happens, pointing up or pointing down, the best spot or where decisions are made in the market is when the slope of multiple moving averages, which we'll get into, is
the launch pad.
What that tells you is now there's indecision. Whatever the primary trend was, be it the uptrend or the downtrend, the existing slope of multiple moving averages being flat will tell you that it's now time to make a decision on whatever the primary trend was, if that's going to continue, or that primary trend is going to switch to the opposite of what, could be a downtrend, an uptrend switching from a downtrend, which is stage, from 2 to 3 to 4, or you go from stage 1 to 2, which is the primary trend was a downtrend, and now you're switching to an uptrend.
Yeah, and I saw somebody mention this is kind of an inverse head and shoulder, where you've got a shoulder, and the head. Again, we're trying to talk about the pieces and the psychology behind price patterns. It's all good and well if you love calling it inverse head and shoulders and all of that's a helpful frame for you. But when you're first starting out, you don't just want to take a sheet of patterns and memorize and just look for that. You want to understand why the trend is changing. The inverse head and shoulder is basically you go from lower lower lows and lower highs to then you start putting in a higher low and you put in that first higher high. So you don't need to memorize what's an inverse head and shoulder, what's all these different names. There's so many out there. Just analyze the trend, look at the price action, use 1 or 2 moving averages, keep it simple, and you'll be able to see charts in a whole new way. So that's just what I emphasize there. Yeah.
Yeah, and one thing that you could do, again, we're talking stages, right? So if you're a stage 1 or you're a stage 2, go back and pick a random stock, go back in time and do this. Mike Webster is big on this, is do a bar by bar, right? So just a hypothetical kind of a simulation for yourself in the back of your mind to train yourself based on, you could do this on price only, right? You could say, okay, right now we're at what, 400 something, Nvidia put in a down bar right at 440. What is your expectation at that point, right? And then you click and you see the next bar. And based on that, you could kind of train your eye. You could do that only for uptrends. Some people tend to do that just to learn that quality uptrends do this. Or you could do just any random, stock and see based on, at that current moment, and you press that arrow to the right and it loads to the next bar, your interpretation level of how price action is forming, couple that with volume to make better decisions, right? Will improve over time. And you could do this maybe, set yourself like a Saturday morning reminder, say for 30 minutes, I'm just going to pick some, maybe a prior successful winner or some other trend and just try to go bar by bar, trying to see how you would trade that. The best way, obviously, Richard, maybe someday in DeepView we'll do it, is we could, mask what stock it is. You pick kind of like a random stock, it loads it for you, and you go bar by bar. You have no idea what this stock is doing, but you could have maybe your relative strength line, price, and volume bars, and you just see if you're going to, you could interpret the very basic price action and identifying trends, be it uptrend or downtrends, week to week, day to day, even 65-minute bar to 65-minute bar. So
yeah, I think it'd be cool to have a set of model book stocks that people can load randomly generated, and then they can trade it as if in real time. And in DeepView right now, you can use the arrow keys to go bar by bar. But yeah, we'll be introducing a lot more features along that frame of mind.